I guess we should start.
Yes, let's go right into it.
Okay.
So Dr. Ku, in your book, The Holy Grail of Macroeconomics, I'll just say it's Holy Grail. Okay, in Holy Grail, you offer a brilliant new concept at that time, and even still relevant today, which is the balance sheet recession. And you use this theory to explain how Japan got into a loss 2 decades after the bubble burst. So last year, one of your interviews went viral in China, which is you offering some remedies for how the Chinese government should deal with the property crisis in China. And you also use a balance sheet recession concept in that interview. And because of that, this concept is now very, very famous in China. All right, so even though I've read your book and also I've listened to many of your interviews, I still want to hear from you in person. All right, so could you please explain to us, what is a balance sheet recession and how do you apply it to analyze the Japanese situation and also today the Chinese situation?
Okay. Let me start out with how I got into this idea in the first place. One day, maybe 1995 or 1996, around that time, I was asking my assistant to come up with how much money Japanese companies raised from both the capital market and the banking system in those years.
Yes.
And then when she came up with the chart, it was a negative number. And I said, gosh, interest rate is almost zero. And the number is actually negative, means Japanese companies are paying down debt. How could companies be paying down debt when interest rates are zero? That's not what we learn in universities, right? And so I started thinking, under what circumstances the whole nation of companies paying down debt at zero interest rates? And the only explanation I think of is that they must have financial problems, balance sheet problems.
That's right.
And of course, Japan had a very big bubble in the 1980s.
Yes.
As a percentage of GDP, I think Japanese bubble was actually bigger than the Chinese bubble. Commercial real estate prices in Japan went up 5 times in 5 years. China's bubble is big, but 5 times in 5 years, from 100 to 500 in just 5 years. So it was a huge bubble. And when it burst, all these people who entered the bubble with borrowed money, their borrowing is still up here, but their asset prices are down here. So they're actually bankrupt. But there are 2 kinds of bankruptcies when you think about it. One with cash flow and one without cash flow. If you have no cash flow and your balance sheet is like this, you're finished. You have to get out. You're finished. But suppose you still have your cash flow. And Japanese at the time, like the Chinese companies today actually, had so many exports welcomed by customers around the world.
Yes.
And so they have plenty of cash flow, but the balance sheet is underwater. In that situation, what is the right thing to do? Well, it doesn't matter whether you're Chinese or Japanese or American. The right thing to do under those circumstances is to use the cash flow to pay down debt. Because as long as you have cash flow, you can continue to pay down debt.
That's right.
And then slowly, you can bring this debt down until your balance sheets are balanced again.
That's right.
And once you get here, you say, I'm out of this problem.
Right.
Let's start making money. But during this process, you are actually minimizing debt, not maximizing profits. But all the economics we learn in universities are based on the assumption that the private sector is maximizing profits. So when that fundamental assumption is violated, and such a large part of the population is actually minimizing debt, then we have to rebuild the macroeconomics from ground up again.
That's right.
And that's where I came up with this concept of balance sheet recession, in that people are no longer maximizing profits, they're trying to minimize debt, but they are doing the right things. That's one of the key problems of this recession. If people are doing wrong things, government can tell them, hey, that's wrong, why don't you do it this way? Right. But if everybody's doing the right things, I mean, if you're in that situation, I'm sure you'll be doing that. If I were in that situation, I'd be doing that. As long as you have cash flow, you can continue to pay down debt. Then you don't have to tell your shareholders, sorry, it's all a piece of paper now. You don't have to tell your bankers, I'm sorry, I can't pay you back. It's all non-performing loans for you. And most importantly, you don't have to tell your workers, you have no more jobs tomorrow. As long as you continue to service your debt, the company is still in existence, still doing business, and that's good for everybody.
That's right.
The problem is when everybody does this all at the same time, the national economy suffers.
Yeah. When everybody's doing the right thing.
Right. This in English is called fallacy of composition. Everybody's doing the right things, but at the end you get the wrong result. I don't know how you say that in Chinese, but when that happens, someone outside this group has to act. Because individually, private sector people cannot change their behavior because they are doing the right things. And in a national economy, if someone is paying down debt or saving money, someone else has to borrow money. And that's how economy moves forward.
That's right.
And in the usual economy, it's the central bank that will raise interest rates higher or lower to make sure that all the saved funds are borrowed and spent. That's why we pay so much attention to the central bank.
Yes.
Monetary policy.
Yes.
In what I call balance sheet recession, even if the central bank brings interest rates down to zero, nothing happens.
Yeah.
Because everybody's still paying down debt.
No one is borrowing.
Yeah, no one is borrowing. They have balance sheet problems, so they cannot borrow. And if you're bankers, you cannot lend either. Because government regulations, whether in Japan or China, elsewhere, will prohibit the bankers from lending to a bankrupt borrower, right?
That's right.
Bank examiners will say you're not doing the right thing. So lenders cannot lend, borrowers cannot borrow. So even if you bring interest rates down to zero, still nothing happens. There's this excess savings in the private sector. And so if I may give you a numerical example, suppose I have $100,000 of income and I spend 900 myself. The 900 is already someone else's income, so that's not a problem. But the $100 that I saved will go through the financial people like us, who will give it to someone who can use
That's
it.
right.
That person borrows and spends it. So the total expenditure in the economy will be $900 that I spent, plus $100 that this borrower spent, $1,000 against the original income of $1,000.
Yes.
And the economy moves forward.
Right.
If there are too many borrowers, central bank will raise interest rates. Too few borrowers, central bank will bring interest rates down. But in a balance sheet recession, I have $1,000 of income. I spend 900 myself. 900 is not a problem because it's already someone else's income. But the $100 that I saved will go through the financial sector, but cannot come out because there's no one borrowing money, even at zero interest rates. So the economy, only within the total economy, only $900 is spent. So economy shrinks from 1,000 to 900. Now 900 is someone else's income. When that person says, okay, let's say 10%, spend 810, save $90, that $90 gets stuck again.
Yes.
Because people are still paying down
That's
debt,
right.
repairing balance sheets.
That's right.
So the economy can go from 1,000, 900, 810, 730 very, very quickly. And this is the worst part of what I call balance sheet recession. It can kill the economy very quickly. And we actually had this happen in the United States after 1929. 1929, October, New York stock market collapsed. And everybody who were in the market with borrowed money realized that their balance sheet's underwater. Everybody started paying down debt all at the same time. But the government did nothing to the situation. And so economy fell into 1,900, 810, 730. In just 4 years, United States lost 46% of its GDP. Unemployment rate skyrocketed
Yes.
25%.
Yes.
So this is the danger of balance sheet recession, that it can kill economy very quickly, very rapidly. The only way to stop this thing from happening is for the government to borrow the $100.
Yes.
If the government borrowed $100 and spent it, then the total expenditure is 900 plus 100. The government spent and borrowed $1,000 against my original income of $1,000, and then the economy can move forward. And that's basically how Japan kept its GDP above bubble peak for the entire 35, almost 40 years since the bubble burst.
Right.
So the key piece that is necessary to fight balance sheet recession is that the government act as a borrower of last resort. Central bank often acts as a lender of last resort. But in the balance sheet recession, government has to act as a borrower of last resort, to borrow and spend $100 to keep the economy going.
That's right.
And when the GDP is maintained, people have the income,
Yes.
so they can continue to pay down debt.
Yes.
And at some point, your balance sheet will be balanced.
Right.
And then the role should be reversed.
Yes.
Government should pay down the debt, and the private sector should start borrowing.
Right. Now, on this topic, right? So because according to your theory, because once the asset price starting to deflate, starting to fall, but that more or less will be the same, and therefore there's a shortage of assets on your balance sheet, and therefore people have to pay down the debt to match the much lower asset price. Is there a way for the government not only just borrow $100, but borrow 1,000, and then the government spend this money to inflate the asset price, so that the economy can get out of the trouble much earlier? Is there such a way to do it?
Well, when the bubble bursts and asset prices start collapsing,
That's right.
people began to realize that they actually made a big mistake. They
That's
should
right.
not have been in bubble.
Yes.
That asset price was wrong.
Yeah.
So once people realized that they were chasing wrong asset prices, it's very difficult for the government to push the asset prices back up, because people already realized that they screwed up.
Yeah.
So unless government could prove to itself and to the people that this is a very short-term phenomenon, that original asset price was a correct asset price, unless there's a good reason to believe that,
Good point.
I'm afraid government will not be able to
Yeah.
keep the asset prices up.
Because I think right now what the Chinese is trying to do is trying to inflate the asset price, so that people doesn't have to go through this dramatic process of paying down the debt as the asset price started to continue to decline. So I would say that in a way it's difficult, because it's very difficult to convince people that the original bubbly price is the right price.
Right.
Yeah, because it's so expensive.
And if the government tries to do that, other people will try to sell to the government whatever as quickly as possible.
That's right.
So,
Yes.
so that they will get the money out and then they won't have to worry
That's
about
right.
this
That
problem.
happened in 2015, right? So there was a stock market bubble back then. So as the stock market price started to crash, then the national team and trying to buy as much as possible to support the price. But then the price adjustment process didn't stop until the prices fall far enough.
Yes.
And everything's got really cheap.
Right.
Yeah, it's quite interesting. Now, there's another experience, right? So if I draw on the U.S. experience in 2008 after the subprime mortgage crisis. Now, what I think the U.S. government did it differently, and I think you were in the Congress testament
Yes.
with Bernanke. So you offer a solution, how to sort out the mess quickly. And I think, much owing to your suggestion, actually the U.S. got out of the mess pretty quickly. Given the standards, given the magnitude was so big.
Right.
But I think the U.S. sort of fixed its balance sheet in less than 10 years. Now, what happened is that the U.S. government started to expand its balance sheet aggressively, so that it actually got out of the debubbling process. And then at the same time, I think the U.S. also has a very rigorous bankruptcy process, so that people will declare bankruptcy so that they don't have to pay down their debt. So is this another way out, so that you let people default, massive default, and so that they don't have to repay their debt, and then at the same time, the government expands its balance sheet aggressively so that we can stabilize their asset price. Then that way, is it sort of a better way to get out of the mess quickly?
Okay, you have two issues in what you just said. The government expanding balance sheets, fiscal stimulus to keep the GDP from collapsing. That's
right.
one part.
Yes.
The other part, and this is absolutely essential.
Yes.
And I'm glad that Chairman Bernanke at the Fed read my
follow your
book
advice.
and actually started telling the Republicans, he himself is a Republican, but he told his Republican colleagues in the Congress, don't cut the budget deficit now. If you cut, the whole thing will collapse, we'll fall off the fiscal cliff, the famous fiscal cliff argument. So that part was good. But when you talked about the other part, whether you should just allow these companies to go bankrupt and clean up the mess, that is not exactly what the United States did.
Oh, okay.
And that's what happened in the housing sector. But when that problem started hitting the commercial real estate sector, even American policymakers said, this is far too big. See, if you allow some companies to go bankrupt, and if this problem is small relative to the total, then the rest of the society can take the shock. But if this problem is really big, then the society cannot take the shock. And so what happened in October 2009, so that's exactly 1 year after Lehman, was that Federal Reserve, FDIC, the Federal Deposit Insurance Company Corporation, and the US Treasury jointly told the banks that for all your commercial lending, commercial real estate lending, even if the value of the real estate is below the value of the loan, you can continue to roll over it.
Ah.
Not only continue, you can, but please roll over it.
Wow.
Because once you're in this situation, these banks cannot roll over the debt.
That's right.
That's against the law. But if all of them then went to the market for fire sale, the commercial real estate prices would have completely collapsed, and the U.S. economy would have collapsed with it.
Finished.
Banks would be all finished, and the real estate market would be all
That's right.
finished. So the U.S. government, understanding the size of the problem relative to the size of the society,
Yes.
did what we call in English pretend and extend. Pretend that everything is fine so that you can continue to extend the loan. And that's how you stop the crash of real estate.
Right.
And this is not the first time. Back in 1982, when I was at the Federal Reserve Bank of New York, we did the same thing when we had this called Latin American debt crisis.
Yes.
And in that crisis, it was the worst post-war crisis. And so many American banks actually were bankrupt on the same day, August 1982.
On the same day.
On the same day when the Mexico went
Wow.
belly up. Only one bank among the 8 major banks was still above water. All the other ones are deeply underwater. At that time, the chairman of the Federal Reserve was someone by the name of Paul Volcker. He immediately understood the gravity of the situation. So he did exactly the same thing. He, together with the FDIC and the Treasury, jointly announced that everything is fine. All the banks are great. Nothing to worry about. It's all lies. Because we at the New York Fed know all of these banks are bankrupt. But by government coming up and saying that, banks did not feel the pressure to write off non-performing loans. So they kept it on the books at much lower prices.
Right. But they didn't have to write down the assets.
Exactly. They don't have to realize the losses.
Wow.
And we went there for 7 years in this mode.
Oh.
Until banks kind of recapitalized themselves with their current profits. And by 1989, finally, banks were more or less above water.
Yes.
It was at that time that government said, okay, let's write them off. So that's what they call Brady bonds. Maybe you have heard of this name, Brady bond. That's how Brady bond came in 1989. But the problem started in 1982. So 7 years, we had to do this very funny action, telling nobody that American banks are all bankrupt, and rebuild the banking system until we were able to write them off.